Hello. This is Domenic Nesci, co-founder at Wealthi. Today, I want to talk to you about some recent data and statistics about the property market. Recently, we're seeing some reporting coming out that the Australian property market is going to hit, or the Australian residential property market is going to hit a value of $9 trillion. This report is a little bit old. It's July's CoreLogic chart pack. The Australian residential market now is worth $8.8 trillion. That doesn't really mean anything without context. So let's put it into perspective. It is basically 3 times bigger than all of Australians' super, about 3 times bigger than all of the Australian listed stock, and 9 times bigger than the commercial real estate sector. So it is one of our biggest, if not our biggest industry. Now, there's 2 things that I found interesting. One, 54% of household wealth comes from housing. So Australians are very invested in their home. They're not likely to walk away from it very quickly. It feels like it's resilient and people really are invested in that wealth. Not to mention the government is invested in that wealth. The other thing, which was a surprising piece of data, is outstanding mortgage debt. So let's put that into perspective. Outstanding mortgage debt is what people are paying interest on their mortgage. Now, if we're going to do a debt to equity ratio, total amount of debt is about 20% or 22-ish% relative to the equity of, let's just say, $8.8 trillion. So for all of the naysayers out there saying that Australia is too highly leveraged, the way that I read and understand this, it doesn't feel like we're that highly leveraged. I mean, I feel actually more secure knowing that our total equity is at nearly $9 trillion and our total debt is, about $2 trillion. So it feels like we're quite a robust market. There's a lot of people out there that own their homes outright, more than we actually anticipate. I won't jump into this huge chart pack. I do want to jump into talking about supply and demand. So let's jump in here. This is another CoreLogic piece of reporting that's come from one of our favorites, Eliza Owen. Shout out to Eliza. There you are. So this thing here is interesting. Australia's dwelling sales to new listings ratio hits an average of 1.4. What does that mean? Let's go down. So for the past decade, the ratio has averaged at 0.9, suggesting for each listing added to the market, there was just under 1 transaction that took place. For every 1 listing, there's just under 1 transaction. When the ratio is 1, it implies that the buyer demand and advertised supply is balanced. For every 1 property that's listed, there is 1 buyer ready to buy that listing. So that's parity. A sales to listing ratio of 1.4 suggests strong selling conditions, meaning that there is a strong buyer demand relative to the amount of supply that's in the market. So for every 1 property that comes on, there is more than 1 buyer willing to buy it. It's very much a seller's market. We're in a pandemic I've recorded the 17th of August, and there is a record low levels of supply because of obvious reasons. So you'd expect this ratio to be more or less at that. But this is leading into July. So that was kind of pre-pandemic-ish. These numbers are really telling me there's a lot of demand out in the market. Some markets more so than others. This is a massive outlier. In Adelaide, there's 2 buyers for every 1 listing. In Sydney, it's 1.5, and then the rest, it kind of cascades down. Very, very interesting data that I think is coming out. This is coming off the back of the fact that there are record low mortgage rates, so it's very cheap for people to go and get a loan. And we've seen that there is a huge amount of savings out there. There's a lot of household support. So people out there have saved some money, and when they come back out of these lockdowns, they're looking to buy something. Interesting stuff. Thank you very much, Eliza. So I'm going to move on. Another thing here, let's talk about this ABS data. I love jumping into the ABS data. So at a glance, let's stop and have a look at this. Let's make my face a little larger for dramatic effect. So in June 2021, new loan commitments all fell. For housing, it fell. For personal loans, it fell. For business loans. However, this is the part that's really interesting. Although they fell for this month percentage change, year on year as a percentage change, as a total, it's 82% higher than last year for housing. And this part here in particular is very interesting. We predicted that, well, let's talk about how things happen. Well, the market really started to run because of buy incentives. First home buyers, the home builder grants, people stepped into the market. That really ramped. All-time low interest rates meant that people kept on buying homes, and it was led by owner-occupiers, people that want to buy their own home. Then we anticipated that with that growth in the market, all these homeowners out there, suddenly their house is worth 10, 20, 30% more. They would take that equity, refinance their loan, take the equity out, and then start to invest. This is what we're seeing. Investor loans are increasing gradually, but year on year, relative to last year, it's 102% higher. That means there are a hell of a lot of investors out there. People are capitalizing on fixed term loans, 16.9% higher than this time last year. We're seeing less construction happening. That's because that builder bonus has been taken out of the market. So that's very fascinating data. We're seeing a lot of investors step in. Investors are starting to compete with owner-occupiers. There's that competitive tension at the auctions. And I think, though, that although the rates are slowing down, we're going to still have a very strong end of the year. Okay, let's have a look at this. This is interesting as well. Personal finance. Fixed term personal lending fell 12.6%. Less people are buying cars, less people are making personal investments. So this is really going back to that last thing, that people are spending less on frivolous stuff, buying cars and whatever else. Personal lending is down, meaning they're keeping more cash available for other stuff going forward. Now, the last part of this narrative that I found interesting, I found this article from Kazoo. They sell furniture and a whole bunch of other stuff. But they sent out a report saying like why their furniture and things has been delayed and why prices are going up. We've been talking about demand, lots and lots of demand. Let's talk about supply. So one thing that I've found very interesting is that, let's just pick wood. Wood mills around the world are working at capacity. The industry has been plagued by labor force issues, beetle infestations due to climate change, chemical shortages, blah, blah, blah. Russia has banned log sales, reducing supply to Europe. The price for wood has increased 400% in the USA. So when we're talking about building materials, supply, it's getting more expensive for builders, developers to bring properties to the market, putting a natural price increase due to the inflation of construction costs. This part here I hadn't thought about, which I found interesting. 60,000 hectares of softwood plantations in Australia were lost during the 2019-2020 bushfires. This raw material takes 20 to 30 years to grow. That's a hell of a lot of supply taken out of the market, again, putting pressure on the price of wood. But it's not just wood. You've got chipboard. Steel prices have increased 200% in the US. Here, iron ore prices have increased by 120%. In Australia, this has only increased by 13%, but this is no small amount, 13%. There is a global impact. Another interesting thing here is that freight costs, the cost of shipping containers have gone up massively. What this means that for people that are in the building industry, getting your low-cost stuff from China or from other places around the world, it's getting way more expensive for that to come into the market. So that is my short synopsis. I mean, I hope that you've got some value out of this. If you have contrarian points of view or have a different take, put them in the comments below. I'd love to hear what you think about this data that we've just gone through. But largely what I take out of all of this is, if I were buying real estate in this market, I would want to be buying fixed price assets. I think that this is a good opportunity to buy brand new homes where you can secure something at today's value and it gets constructed 9, 12, 24 months in the future, because there's a clear trajectory that the prices are going up. Even just from the raw material point of view, it's going to be more expensive for people to deliver that home. So for developers coming in, and you're lucky to be one of the first few to give the developer pre-sale secure funding, a lot of developers now, what they're doing is staging the prices. So they secure prices here for the first 10, 20, 30, 40%, and then they leave the remainder of the development to later. So once it's completed, a lot of the risk has been taken out of the building. People can walk around the house, the apartment, the townhouse, and the developer ratchets the price up to recoup a lot of the losses that they've made for the price of construction and whatever. Now, the other reason why I think it makes sense to be buying for stock at a fixed price is I wouldn't want to be at the auction house today. I wouldn't want to be competing against investors, owner-occupiers, wannabe developers and home builders. I think that we're going to see a price increases from now until the end of the year. And then I also anticipate that that will keep on going into the new year. It may not be as fast as we've seen at the start of this year, but all the early indicators say that we're going to see a strong tail end of this year. Anyways, I hope you've enjoyed this, and stay tuned for more updates.